Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right. I said it. I don't care who knows it. This show is designed to help us all grow our money. You see, we take our precious time, we go to work, we get a paycheck in order to provide. We take our time, we go to work, which is a blessing from God. We get money in order to eat. But imagine a world where you could work a little less if you wanted to, and money could make you money, so you could spend that time with the things and people that mattered most to you, whether it's family, friends, engaging in a purpose that's bigger than yourself. And so that's what we want to help you learn in all the different episodes. Super excited about today's episode and today's guest. We're going to be talking to my good friend. Wait for it. We'll be right back. On today's episode, we talk to my good friend, Karl Brady, and he's teaching us how we can make money investing in apartment buildings.
And I would always argue, and which I think has been proving over the last year, that multifamily really has the kind of stability.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rob. Welcome back to Everyday Investor. Before we talk to Karl and learn how we can make money investing in apartment buildings, let's find out what's happening in the world of stocks with our stocks expert, Omar Khan. Over to you, Omar.
Thanks, Rob. Omar Khan here, guys, with Data Trading with a weekly market recap. Markets were down again last week. They've been down a few weeks in a row. The major indexes, the S&P 500, the NASDAQ, all down a little bit, but pretty good for the year so far. What we've had is a void period of news. So there's not been a lot of news since earnings. The majority of the earnings were announced around May 10th. And since then, there's not a lot of news. When there's not a lot of news, sometimes the news gets filled up with negative news. And that negative news continues to be the word inflation. Now, inflation is a nasty, nasty word in the stock market because, well, it costs more to borrow money. It's harder to make money during inflationary periods for some companies. And that's why the market's worried right now. So it's pulling back a little bit. Also, it's done so well over the last year. Some people are just taking profits. Now, again, the main determinant, what drives stock prices higher, is earnings. That is the ultimate key, and they came in strong. So let's see how the economy unfolds the next few weeks. But so far, so good. Earnings are really, really good, and that's what we got to focus on. Back to you, Rob. We'll see you guys next week.
Thanks, Omar. Always great to hear from you. My friend, Karl Brady, how are you?
Hey, Rob, how's it going? Good to see you.
Yes, every time I get to speak to you, I get a little nostalgic because, of course, the other side of my family, my wife and her brothers, and they come from your home country of Ireland. And it's just always great to learn from you, be educated from you. But also, I can't lie, I love the accent.
Oh, wow. I didn't think I had an accent. I thought it was you who had the accent.
That's right. But listen, I can't believe, from a place, let's just take Dublin. Dublin is what? I think 1 million people? How many people are in Dublin?
Yeah, a little over 1 million. Probably getting close to 1.5 at this stage.
Yeah, so 1 million, a little bit more. And so much goodness comes out of there. I'm talking about just a lot of great stuff that comes out of Dublin, right? I mean, Karl Brady comes out of Dublin. There's a lot of good stuff. Why do you think that is? That kind of relatively a small place. I mean, I guess 1 million people is not small, but what do you like? What do you love about going back home and the culture of Ireland?
Yeah, like listen, I guess Ireland has always had a tradition or a history of people leaving and going, going abroad to work and many other countries, the UK. So I guess it has a kind of a population that sees a lot of the world and that's kind of diverse and gets to kind of, spread their roots kind of around the world. Of course, what I obviously love about Ireland and Dublin is what everybody else says who visits Ireland is obviously the people are great. All my friends, my family are all still there. So it's obviously somewhere that I love a lot. And of course, the beautiful scenery. It's a great country to kind of drive around and get to see. Obviously, tourism is its biggest sector, its biggest industry. And I would always encourage a lot of people to go and visit. You gotta always anticipate that the weather may be a little unpredictable, but you'll definitely get a warm welcome from the people.
Listen, thank you, Karl. I know you're a very busy man. You work with Grey Brook. You're also the president of Grey Springs. And talk a little bit. We're going to go through some numbers, and we're going to look at what kind of return on investments we can make. But talk about this concept of investing in apartment buildings. I mean, I would say it's pretty hard to lose if you know a little bit. It's pretty hard to lose investing in real estate, especially in the last 10, 20 years in the greater Toronto area. It's pretty hard to lose. But one thing that I would always say be careful in is when you're getting into the multifamily space. I mean, that's kind of a graduated step, if you will, when it comes to investing in real estate. You guys have made it very easy for guys like Rav, because I just have to write a check and I get to invest alongside the big players like Grey Springs. So talk a little bit about what's attractive about investing in apartment buildings and why somebody like Grey Spring is a good go-to.
Multifamily real estate investing or as an asset class is very topical at the moment, right? We're in the middle of the pandemic, and the pandemic has kind of demonstrated or at least shown that although, as you correctly pointed out, real estate, has been very successful. There's different parts of real estate, of the real estate sector, that have different characteristics. And I would always argue, and which I think has been proving over the last year, that multifamily really has the kind of stability. We've been through a pandemic. There's been, still in a pandemic, but there's been a lot of uncertainty. But multifamily apartments have continued to be a bastion or a safe haven for a lot of capital. They've continued to perform over the last year in many different metrics, not only investment, but through its actual fundamentals of rent collections and so on and so forth. So multifamily over the past few years has definitely been a target or an interest for Grey Spring. We got into the multifamily space of acquiring multifamily properties with a plan to reposition them or I guess renovate them. About 2.5 years ago, we've accumulated a little over 1,800 units over that period of time. We see a lot of opportunity in our strategy, which is to buy not necessarily undervalued, but properties that have not had a lot of care and attention, a lot of money has been invested in them. They've been basically operated as cash flow plays. We see a lot of opportunity to spend some money, renovate, and give tenants the kind of living experience that they're looking for. We're trying to fill in that segment of the market of people who want a really nice place to live, a new renovated type of unit in key areas, and are willing to pay a bit of a premium for that. And of course, we're offering that product, and then it gives us the opportunity to obviously invest in that and make a return for our investors.
So, Karl, with those, and obviously, I know it's a great segment of the investing sector because they're hard to come by. A lot of these mom pops, and when I say mom pop, I don't mean like a 10-plex. Well, let me ask you: of the 1,800 units that have been acquired so far, and I know you're not stopping, in one dwelling, what's the average? What would be the average unit size in one dwelling, would you say, of the 1,800?
Yeah, I would say the average is probably in the kind of 70, 50 to 75. The sweet spot is where you're trying to get 100 north of 100. But there's, in this space, as you correctly just said, it's very difficult to find this type of product. A lot of older apartment stock is held in the hands of smaller or private owners, who don't really have an incentive to sell. So it's hard to come by, which means you have a wide variety of products. But I would say our average holding or our average building is probably somewhere in the kind of 50 to 75 average unit count range.
Yeah, and so I was going to say, I'm not talking about a 10-plex, 20-plex. I'm talking about 50, 60, 70, units, and privately owned, and of course, maybe passed down for generational wealth. And they're just looking at it from the cash flow. They're saying, okay, this is pretty much paid off if it's not already paid off, and I'm collecting rents from 75 different tenants. And then what they're not seeing, which GreySpring has coined, and you even mentioned the word, the value add. And so your strategy at GreySpring is to buy, undermanaged, again, undervalued, if you will, do a little bit to the units, add value, and what we don't understand often is what that does to the actual value of the entire dwelling, and it can be astronomical. So what's the GreySpring play? Is it we acquire these properties and then RAV invests with GreySpring and it's legacy, or is there an exit?
Yeah, well, for us, I think the optimal strategy or the optimal approach, it varies slightly, but generally speaking, we are trying to, turn over, or I guess through natural turnover in the property, renovate as many units as possible in a relatively kind of condensed or a timeline, or an achievable timeline, I guess. How we generally see that, the average timeline is usually somewhere between, I would say, 4 to potentially 6 years. Portfolios are turning in some of the markets we're in. We see 20% or north of 20% average turnover, which means over a 5-year period with the kind of diminishing turnover, you would expect to turn approximately around 70% of the property, which would generate, it's in that good sweet spot where we feel it generates a very good return for us, and then leave some units for the next buyer, whether it be another institution or another kind of private buyer, that there's some room for them to grow as well as having a stabilized asset at that point in time.
Fantastic. And minimum investments, same kind of investment strategy, around $25,000, registered funds, cash, all that kind of stuff?
Yeah, that's right. Yeah, it's the same, $25,000, registered plans, cash investments, of course, as well. So yeah, it's the same.
Okay, great. Well, let's look at projected return on investment when we come back from the break. We're talking to my good friend Karl Brady, president of GreySpring, and he's teaching us how we can make money investing in apartment buildings. Don't go anywhere. We'll be right back.
At Theta Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course, or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
Hey, it's Rob. Welcome back to Everyday Investor. I'm talking to my good friend Karl Brady. He's teaching us how we can make money investing in apartment buildings. Before we continue with Kyle and he breaks down the numbers for us, let's find out what's happening in the world of mortgages with our mortgage expert, Kyle Ford. Over to you, Kyle.
Thanks, Rob. Well, the announcement's official. The qualifying rate has been moved from 4.79 to 5.25 effective June 1st. Though this was initially thought to be just for conventional business, it's going to be for insured business as well, which is going to impact our first-time home buyers. This means an approximate reduction of borrowing capacity at about 4 to 4.5%. Now more than ever, we need to be taking an investor-focused approach to buying our first property. So maybe that means buying a house with a suite so you can use that rental income to help qualify. Make sure you're disclosing all income sources to your broker or agent, so including child support, alimony. If you have a small business that you claim a little bit of income every year and you have a 2-year average, that can be used to help qualify. Maybe you'll consider partnering with a friend on that first-time home purchase, or going to what many Canadians are doing right now, which is to the bank of mom and dad to get that co-sign signature to help boost up that qualifying. Now more than ever, make sure you're working with a broker or agent who has access to multiple lenders, who's going to shop around and customize a solution that works best for you and your family. Don't hesitate to reach out. Thanks, and back to you, Rav.
Thanks, Kyle. Always great to hear what's going on. My friend Karl, thanks so much for being on the show. I noticed the nice Toronto skyline there behind you. So from a guy, let me go back to the Dublin roots. What are your thoughts? I mean, you don't have to be biased because you're not necessarily from the nice scenic backdrop that's behind you. What are your thoughts about Metropolis here, the Toronto area, you know, from somebody that's, you know, kind of born and raised abroad?
Yeah, listen, I think it's probably what you've heard before. I think Toronto is an amazing place to live with a lot to offer. You know, a lot of growth. It's a city that has had a massive growth over many years. I've been here since 2011, and even since the amount of time that I've been here, unfortunately, I do live downtown. I have seen so many changes. You know, I've seen a lot of growth, a lot of construction in the city. You know, it's a multicultural with a lot going on, whether it be arts, entertainment, sport. So I think, you know, Toronto always has a lot to offer, which is why we constantly see it being ranked on all of these lists that we see get published all the time of one of the, you know, most desirable or the best places to live. And I would for sure be in agreement with that.
No, I agree with you. Okay, so when it comes to investing in apartment buildings, we're not just buying an apartment building and making money from the tenant. The Grey Spring strategy is to buy undervalued or undermanaged is probably a better word, and then add value to this particular units, and then of course all the common areas, and that does something magic with what's called the cap rate. So teach Rav how I can make money investing in value add apartments. And Karl, this is not just, we're not doing this necessarily in Toronto, right? Are we buying, those 1,800, where does that geography cover?
Yeah, so that's right. So a lot of our portfolio, obviously, you know, it is North America. We do have, you know, a couple of assets in the US, but the bulk of our main focus, particularly where we see the biggest growth opportunity, is mainly in Southern Ontario and also in Quebec. We have a heavy focus. We have approximately, you know, maybe 800-900 units in the Montreal area. We have another couple hundred units in Quebec City, and then, you know, spread out after there. So Montreal and Quebec is where we see a big opportunity and is where we're continuing to grow.
Well, I think that's brilliant because, I mean, over 50% of yours is in Quebec. In Quebec, a lot of people come there from Europe, and in Europe, you know, it's very common to rent. And so, of course, where there's a lot of demand for that, you would invest. So I think that's brilliant. Okay, so how do we make money? So, you know, give me an example, just, you know, kind of hypothetical. How many units are we buying in this one dwelling? 50, 75? What?
Yeah, we can say, you know, 150 units would be, as an example, would be a, you know, perfect kind of sweet spot of something that we will be looking at.
Okay, so what you're saying is, when you acquire, you might be buying 2 or 3 dwellings in one acquisition to give you the 150 units. Is that what you're saying?
Yeah. Sometimes now we have had some acquisitions where we will buy a specific building. Like we do have properties where the one building can have 200 units, right? So it's not uncommon for us to acquire 150 or 200 units in one building, but that also, as you correctly pointed out, could be made up of, 2 or potentially 3 buildings clustered together, which would be one kind of community, but I guess 3 smaller buildings.
Okay, great. So we've bought 150 units at, at 123 Main Street in Quebec. And for whatever reason, you look at this and you see that it's kind of been under managed. And Gray Spring says, hey, we can increase the value on this. And so how do we do that?
Yeah, of course, the most the strategy, I guess, that Gray Spring deploys is a couple of different things, but the focus, I think, for the purpose, the most easy to illustrate is by increasing rents as a result of giving the market a different type of product, which is a renovated unit, right? So generally what Gray Spring is doing is we're coming into these old units, completely doing a renovation. Average spend, I would say, if varies depending on suite type, of course, and size, but our average spend is probably in the $20,000 range is what we would spend on renovating one of these units. Of course, it means modernizing kitchens and changing floors and bathrooms. It'd be $20,000. If you look at an average market, like let's say we pick Montreal as an example, where maybe unrenovated average rents would be probably $1,000 a month, pre-renovation for what we would call, a traditional product. You spend your $20,000, rents for renovated product, we would average see kind of $1,300. Truthfully, maybe even a little north of that. But I think, for this purpose, we'd say like $1,300, which would be a $300 a month rent lift. So obviously, you do that times 12 and you're at $3,600 a year of additional rent premiums from this one unit. And then obviously that generates a value, right? Like that generates a value. So obviously, as you have correctly pointed out, we use, it's a little bit of kind of real estate, I guess, jargon, but we use the concept of cap rates. Cap rates is not the be all and end all, but it's a very good way to assess the potential investment opportunity in multifamily apartments.
No, I love that, because just from looking at this, and not to take anything away from mom and pop or for the families that own these, but they would be saying to you, Karl, right now, wait a minute. You told me I need to spend $20,000 for the one unit, but I'm only making $3,600 on that one unit. And so now we know why they probably, it's going to take me to recoup that, right? It's going to take me a good 5, 6, 7 years just to recoup that. And so that's a reason that people don't understand. But what you're teaching right now, and you've taught before, is the cap rate, that every kind of area has its own cap rate. So for you that are watching, just remember this number. Sure, we spent $20,000. We made the $3,600. So I'm just going to erase this. And what I've learned from guys like you, Karl, at Gray Spring, is that if we take the income and we divide that by the cap rate. So in this case, a cap rate would be what? Give me, what's the real cap rate in this kind of area?
Yeah, it obviously varies, of course, by area, but I think, let's say we pick Montreal again to continue that example, it can vary, somewhere in the kind of high 3s to low 4s. So I would say like a 4% cap rate is probably a good mid-range for this market.
And you said we increased the income on this one, 3,600?
That's correct.
Okay, so is that what we do? Is if I take this income and I have one unit and I divide it by 4%, and that gives me the lift of value? Is that what we're doing?
That's right. Yeah, that's exactly how it works. Yeah. So you take 3,600 divided by the 4% will give you a $90,000 increase.
Pardon?
A $90,000 increase. Yeah.
90,000. Okay. 90,000. And then of course we spent 20. Is that what I'm doing?
That's right.
Okay, so this is what people don't understand, that there's a cap rate, and you know, I'm not a great teacher of cap rates, but generally what I understand is I could go down, you know, Saint Laurent in Montreal, and there could be this building, and there could be a laundromat, and there could be a car wash, and there could be an arcade, and there could be a, you know, if they do that in Quebec, not sure, marijuana store. And how am I going to compare the value of all these things? It's not like I can compare this apartment building with another one right next to it. And so what they give that area is kind of a capitalization rate, generally speaking, and we won't go into all the details, but that's what, in this area, real estate is at 4%. That's what you're saying.
That's right. Yeah. The other way to look, it's kind of like a multiple, right? A reverse of a multiple. So the way people, it's the return people will expect for a specific area with all its characteristics, as you correctly said, on a kind of unleveraged. So in this market, what I said, somebody would be looking to make, the market would be willing to accept a 4% return on an unlevered basis.
Love it. Okay, so I increased the value of that one unit by $70,000. Time flies when we're having fun and being educated, so I only got about a minute left. But you told me that there was 150 units. So are we going to do this to all the units realistically in the 4 or 5 years? Or how many units are we going to do this to?
Yeah, so in general, you wouldn't be able to do it in all units because, of course, there's going to be a lot of people who will stay. So, you know, you generally target somewhere between 60 and 70% of the units that you would do this at. So at 70% of the units, on this example, it would be 105 units.
So 105 units times 70K is what?
Yeah, that would be $7.35 million.
Net.
That's right.
So you've increased the value of this property over 4 or 5 years by over $7 million. Of course, we're doing a little bit to the common areas, so we'll knock this off. But this is generally why people love to invest in apartment buildings.
That's right. That's the concept, yeah.
I love it. I love it so much. And there's no stopping for Gray Spring. You're still acquiring, you're still looking at all over North America where the numbers make sense for you?
That's right. Yeah. Right now, we're still in the market. We're looking at a lot of opportunities. We're assessing a lot of, we're always pursuing. As we said at the start, it's not easy to find opportunities in this market. That's the main challenge. But yeah, we are working full time, trying to chase down these opportunities and continue with our strategy and our plan. Love it.
Listen, when it comes to the downside, any risk, I'm sure it's the same as land development, where if Rav's going to invest his $50,000 into something like this, I can't expect it back right away. It's not like a stock and I push a button. It's in here for the 4 to 6 years, number one. And if it takes 7 years, then it may reduce my projected return on investment. The projected returns generally in something like this is?
Yeah, there's a range depending on obviously what markets we're in, but we're generally targeting somewhere in the 12 to 16% of a average annual return range for this type of asset.
Karl, time is up. Thank you so much for being on the show with me, and look forward to having you again in the future as you continue to acquire more properties here with Gray Spring. Thank you so much.
Thanks very much, Rob. I appreciate it.
Yes, and thank you guys for watching. Without you, we would not have a show. Make sure you tune in next week, same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.